let's talk about another one, which is seeing a big up move. That's Inox Wind. It was a strong quarter for the company. Sharp expansion in the EBITDA margin due to superior sales mix. Devansh Jain, who's the ED of Inox, joins in now to give us more on the first quarter performance, but more importantly, what the year ahead looks like. Thanks a lot for joining in. First up, if you could, confirm whether this 140 megawatts of execution run rate continues through this year. What's the outlook out here? And margins as well. I mean, very strong, a little about 21%. Does that sustain? What are the levers here?
Hi, good morning. Pleasure to be back on CNBC. So as you know, Q1 was the highest financial performance in the history of Inox Wind. Our revenue was up about 85% and EBITDA was up almost 350%. Coming to your question on margins, look, we've guided for about 15 to 16% margin for the entire financial year. And obviously, there could be a slight upside to that as we move forward. But having said that, we continue to maintain our guidance at 15 to 16%. This quarter has been close to 21%, but I think in the course of the full financial year, we should be closer to the numbers I spoke about. With respect to the 140 megawatts you talk about, as I think is well known in the industry, Q1 is probably the lowest, Q1 and Q2, given that it's onset of monsoon, and Q3 and Q4 typically are the highest. So I would tend to think that Q3 and Q4 would be far larger than our Q1 numbers.
All right. Hi, Devansh. First of all, congratulations on a good set of numbers. You have been walking the talk, so that's good news from an investor's perspective. A couple of details I wanted. Are you facing some logistical issues? Because that's what some part of the street believes. Could you clarify on that front? And what is the breakup? This 800 megawatt is well and truly on, 300 in the first half and 500 in the second half. Give us some more details on that, on the execution.
Look, I'm not sure where this logistical issue question has come up from. We face no constraints whatsoever.
Okay.
Business is on track. We have publicly stated our vision to be a 2 gigawatt company in the near future. And I think we should be achieving that sooner than what is expected by most of the street. We've also gone on record to state that there is a fairly large upside to our FY26 numbers. While we've not upgraded the 800 and 1200 megawatts targets which we've set out for ourselves for 25 and 26, I think the order book in itself speaks volumes, and our current run rate of execution and profitability gives a fair amount of hint of where we are headed. With respect to your question of 300 and 500, look, we've stated our guidance of being an 800 megawatt supply or execution company this financial year. And I think we are very well on track to achieve that.
Got it, Devansh. So 15-16% margins, 800 and 1200 megawatt in the next couple of years, and no logistical issues. Part of the investor community had that query, so that's why I put it across to you. Let's get a couple of more details. Your current order book is around 2.9 gigawatt. Over what span do you see this getting executed? And also, if you could give us a sense of the commercial and industrial demand. Is that strong? If yes, should we be looking forward to some more announcements on closure of some orders?
Look, the 2.9 gigawatt order book, again, is the largest we've ever had in our history. Typically, this is something which we would execute in about 2 years. You typically get orders, private sector gives you orders which typically give you an execution timeline of about 12 months. PSUs typically give you orders where the peak execution cycle is about 24 months. And then you've got retail and smaller C&I, which would be about 6 to 9 months, within which I would tend to believe the 2.9 would be executed in the next 24 months. Again, I did mention that we are gunning to be a 2 gigawatt company in the near future. But again, depending on how fast and how large the Indian market is, we could see a much larger play out as we move forward. As we've announced in this quarter, we've already started setting up a larger nacelle manufacturing facility in Ahmedabad in Gujarat, which would enhance our ability to manufacture beyond 2.5 gigawatts of nacelles. So we are gearing up for the future. With respect to the C&I order book, yes, I think we're seeing tremendous momentum, driven by multiple reasons. Primarily, of course, is that renewables is the cheapest source of power. Second, I think a lot of exporters, given that you now have CBAM coming up in Europe and eventually carbon taxes coming up in different parts of the world, particularly the developed countries, you would need green credentials and renewable power. And what's better than renewable energy? Moreover, a lot of the larger corporates are setting up their own platforms. So it's a win-win. They raise equity there, they create value on that front. The operating entities themselves, without any capex, gain significantly. We will be announcing a much larger play even within the Inox GFL group for our own captive renewable energy requirements. But I think the C&I market is booming.
Right.
We've announced about 600.
Devansh, just a quick word. In terms of acquisitions, I mean, Suzlon recently announced an acquisition on the OMS side. Will a lot of this ambition be via sort of buying companies? I mean, are there enough players in the market? I mean, that Suzlon, we spoke with the management of Suzlon. It was it was on the OMS side, and it was pretty small as compared to Suzlon's size. I mean, so just give us a sense of that. How much of this ambition is going to be via acquiring companies out there?
Look, what we're talking about is our Inox Wind, which is a manufacturing company supplying turbines. And on the C&I side, you're really supplying newer and newer turbines to take care of the incremental power requirements or the existing power requirements of thermal, which are being replaced by renewable energy. O&M is a different piece altogether. That's something, as you may be well aware, we probably have the only.
Devan, I was just using that as an example. Are there on the manufacturing side, will there be sort of M&A strategy? Are you looking at opportunities?
Well, we are looking at opportunities, but that's more on the O&M side, not on the manufacturing side.
Okay.
I think at Inox Wind, we have the lowest cost structure. So I don't think there's anybody to acquire out there in terms of who could be value accretive to Inox Wind. But
so
yes,
just two-part question. Right.
A lot of acquisitions on the Inox Green side of things, where we expand our O&M portfolio.
All right, so just two-part question then. One would be on the acquisition itself. What is the size that you're targeting, if any, timelines, etc.? That's point number one. And secondly, you did briefly speak about C&I. If you could give us a sense of how big the market is, how big do you expect to be in this over the next couple of years?
I'm sorry, I could not hear you. I think there's a cross connection. Could you repeat?
Yeah, so can you hear me now?
Hello?
All right, you want to try this?
Yes, Devansh, are we audible?
Yes, yes.
All right. I think Mangalam has a query, but he'll get back with that one. I wanted to ask you about the interest cost. You know, on a quarterly basis for the last few quarters, it's been in that vicinity of around 56 to around 65 crores per quarter. Now, for the past quarter, your PAT number itself was close to 50 crores. But as you'll have put in some money and you're virtually debt-free, if I understand correctly, that interest cost should come down on a quarterly basis. So from this 55, 65 crores per quarter, what does the interest cost come down to from quarter two onwards?
Look, I think we did mention we are now a net cash entity.
Yes.
And what's also been publicly stated is from Q2, our net finance costs should be negligible. So yes, you see a large chunk, you see 50, 58 crores over the past 2 quarters, but a lot of it also had to do with a lot of the repayments we were doing and a lot of one-time charges. I think for the full financial year, we've guided for net finance costs to be in the vicinity of 60 to 75 crores, which would entail a saving of almost 200 crores from the previous financial year. And given the fact that we are net cash now, I think this is behind us. I don't think finance cost is something which is going to be anything which is going to be really key. It's really going to add to the bottom line going forward.
Yeah, that's the reason I ask you that, because as of now, PAT as well as interest costs are almost the same. So that interest cost comes down drastically,
I think
then that will get added to the profitability.
I think that should virtually double, given that we've mentioned that interest costs from the next quarter should be negligible.
All right, final question then. I hope you can hear me now. Is because on the C&I business itself, you said that on O&M you're looking at some opportunities. So if you could give us a sense of the size and the timeline that you're looking at in terms of any sort of inorganic plans there. And secondly, on C&I, how big are you planning to be here in the next, say, 1 to 2 years?
Look, first and foremost, on the O&M opportunity in Inox Green, we had recently raised about 1,050 crores, which is primary. We are evaluating multiple opportunities as we speak, but we have a very prudent capital allocation policy. We will not buy out entities just them out or at numbers which make no commercial sense to us. We are looking at a very value-accretive business model under Inox Green, which is beyond just servicing turbines. We'll talk about that more as we in the coming months. But I think we are evaluating multiple opportunities. That's all that I can say at this point in time. With respect to the CNI market,
CNI. Yeah.
look, I think, we're not married to C&I or retail or PSU or SECI tenders for that matter. I mean, at the end of the day, the Inox Wind, we're supplying turbines. Having said that, I think the C&I market is just getting larger and larger. So maybe a year ago, our PSU market or order book was almost 70% PSUs. Today it's down about 35%. We've strategically also diversified across multiple customers. We have 7, 8 very large customers. We intend to add about 3 or 4 very large customers in the near future. And I think I would tend to believe C&I should be about 60 to 70% of the market as we move forward.
Okay, all right. Commercial and industrial, 60 to 70% of the market opportunity out there. But as you say, of course, you go where the opportunity is. Thank you very much, Devang, for joining us. It's a pleasure, and good luck to you and your team as you continue to execute well.